Good afternoon, everyone. Welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is November 1st, 2023, and today is Fed Day. So today we're going to talk about the fact that the Fed did nothing, the market loves it, and yet they justified reasons to raise rates. So let's take a closer look. Starting out with the Nasdaq, we can see that we have a very bullish day. We're up 1.8%, pushing higher. Now, I think we're probably going to test 14,800. I can show you some of the levels that we would expect there and why we would think it's going to test there. But 14,800 is certainly on the docket, potentially for the Nasdaq before the end of the day or first thing in the morning. But as we're rallying and we're seeing prices move higher in the Nasdaq, this is in response to the Fed not raising rates, and therefore the market is saying, aha, we know that you're not going to raise rates anymore. In fact, we are going to bet on you cutting rates. Now, if you'll note, the ZN is also up. So normally we do not expect to see bonds and prices here, bonds and equity prices, move together on an intraday basis or a daily basis. Instead, we kind of expect it to move like a double helix. So when I say a double helix, what are we doing? We're saying that you're going to see equities climbing, and you'll see bond prices climbing on the long term, but kind of going less of a magnitude at a lower case, like this. Now, the fact that they're falling and rising opposite of each other, but they're netting out upward momentum, that is inflation. That is that the things that we're selling cost more. Whether we're selling equities or selling bonds, they cost more. That's dollar weakness and inflation. So when they're rising together in the long term, that's inflationary. If we see that they're going opposite each other, that's generally fear or confidence, growth mindset or protective mindset going on in bonds and equities. But when they both rally together, when they both go higher together at the same time, that's an indication that we do have inflation. We're betting on inflation, and that's exactly what the Fed said today. Let's take a look at the press release. Now, this is directly from the Federal Reserve press release. You can see they said the recent indicators suggest the economic activity expanded at a stronger pace in the third quarter. So they're already saying the economy is strong. We're doing fine, stronger than expected. That's even stronger language than they've used in the past to describe a healthy economy. Secondly, they also say inflation remains elevated. So why is it that if we have a strong enough economy and an inflation that remains elevated, why did we not raise rates? In fact, they continue to talk about the things that tighter financial and credit conditions for household and business are likely to weigh on economic activity. They tell us the reason why they did not raise rates is because they know that we have tightened the monetary policy. So despite the fact the economy is strong, despite the fact that economic conditions are still improving, despite the fact that inflation is still there, and all the justifications are to raise rates to stop inflation and to really create a destruction of demand, we're not seeing it because, one, we're still spending money, but two, we're spending it on debt. The problem is if we're spending it on debt and the monetary policy, the money that is monetary policy M2, which is basically cash and savings and bank deposits, when we look at that, it is the biggest contraction of monetary supply in history. One of the greatest expansions of monetary supply and one of the greatest tightenings ever in monetary supply. So we've tightened down the monetary supply, which means that people don't have money. We don't have nearly as much money as we did just a couple of years ago, and I can show you that right on from the Federal Reserve as well. I've shown this in the main room before, but just to remind you, you can go to Analyze tab, Economic tab, and look up M2 Real. And what you're looking at is you're looking at this huge spike. That's a ton of extra money going into the market. We saw a massive inflow of capital during the COVID spending, but we're already headed there in 2019. We continued it in 2019. 2020, we broke through the high as we saw the increased supply, pushing to stop or to curtail COVID through different things. Well, we saw that erase of that and a drop down and a recovery all the way down to clear the lowest level. And any time historically that we've been below 0% year-over-year contraction of money supply, we have seen a recession. Every single time. So they know that money supply has tightened to the point that we have seen a reason to justify or expect a major recession. In fact, this is in dollars. If we want to do percentages, you can change it to percentages. And you see it's a very similar chart, but a percent change, we've seen a percent change down to 9% negative, contraction of 9%. And that was just from last year, not from the peak. So as we're looking at it again from billions of dollars, changed from a year ago, billions of dollars, we pulled almost $700 billion out of the market from a year ago. That's significant. Anytime we go into negative, pulling money out of the market, that is usually a sign of destruction of demand and a contraction of money available. So spending is done on debt. We're seeing higher debt defaults, some of the highest levels we've seen in a while, but that is the reason why, again, we're saying we're not going to raise rates, because they need time. They say that the cumulative tightening of monetary policy, the lags which with monetary policy affects economic activity, inflation, and economic and financial developments is what they're waiting for. They're waiting for this to play out. But the problem is we've now been waiting out 2 years of tightening, and we still haven't got a decision to raise rates anymore. We have not raised rates over the last 3 meetings, which takes us all the way back to June. And so how much time do we need to see that? The issue we have is not just that we've tightened the monetary supply and that we've raised rates. We have a situation where we have to reissue debt. The debt that the federal government has, they do not have the ability to pay it off. And so what they will have to do as those notes come due, those treasuries and those bonds come due, they will have to reissue it just to keep things going. And in addition to that, not only is it trillions of dollars that have to be reissued over the next couple of years, we know that they're trying to get $1 trillion of treasuries out the door into supply to fund the government. What happens when you add supply of anything to any market? Well, if we add a bunch of 10-year treasuries into the market, treasury bonds to the market, then there will be an excess supply. If we have more and more bonds available, then bonds will necessarily turn over and run back down. Prices will fall. If prices fall here, anywhere below this about 108.07, I would say it's just a continuation of the downtrend. Lower highs, lower lows, lower highs, lower lows. Now, as we take a look at the big picture, if the Federal Reserve is going to issue more debt, and the bond prices are going to fall, even if the Federal Reserve doesn't raise rates and the Treasury issues more debt and the Federal Reserve reissues, or the federal government, reissues their debt, and they're doing it at 5.5%, the cost of their debt goes up. The problem is they put more bonds in the market and the yields go higher. That's how it works. If we look back historically, I've been targeting a 5.3% rate. If we go back further, let's just go back as far back as this TNX chart will take us. And we'll go to the max. And we've been talking about that 5.3% rate. I've been talking about that for the number of months now. And I do think we're going to get back to there. That's going to be, in essence, testing the high from 2007, right before the banking crisis and real estate crisis. Well, I'm starting to think that we have shown no signs of really a pullback. I mean, this is a tiny little bit of a blip for the month of November, but it's day one. So we have a lot of time to go before we see this month be red. We have not really seen a downtick, and we certainly have not seen lower highs and lower lows. So not only am I looking at to clear 5.3, I'm actually looking for us to get back to the 96, 97, 98 highs, which means we could be seeing a 7% interest rate. Now, 7% interest rate compared to a 0.4% interest rate means that we're borrowing at 6% more. Now we could expand that and say that's 12 times what we were borrowing at in 2020. Paying 12 times the amount in interest than we were in 2020 as far as dollar amounts are concerned. And that is a major problem. And if we look at the ZQ being a representation of the Fed funds rate, the short-term rate, you can see the Fed funds rate, when it's up here at 100, that means 0%. In fact, this is what's called a discounted rate. A discounted rate, and I've shown this math before, a discounted rate tells us that if we're going to take 100, we're not charging an interest rate, we're charging a discount. So we take this number 99.96, and we get it 100 minus 99.6, so you're charging a 0.04% rate. That's what the rate was. And so really all this time was a 0% rate, or 0.4%. All of this time, this would be the Bernanke years of the quantitative easing post the 2007-2008 peak of the economy and market crash. And so then we got to the 0% rate, which we held from 2008 all the way over to 2016, and we tried to tighten. Well, this was tightening. We raised rates. We dropped the short-term rate was at 0. We raised it up to about 2.5%, and then we decided, whoa, this is hurting the economy. In 2019, we had to cut rates. COVID hit, we left it at 0. Well, we can do technical analysis on this too. We created a double top at 2.5%. We broke out, we went to 5%. That's what that 95 would represent. So we've seen that 5.25%. But the thing is, this is the lowest level we have been at as far back as we can take this chart. So pre-2007, pre-crash from the economy. So we're already at this level. And the only way we get from an inverted yield curve, which is where we're at, where short-term are higher than long-term, is to either raise the long-term or lower the short-term. We can't lower the short-term. We cannot lower the short-term. If we lower the short-term, we're going to create even more inflation, a bigger problem. And so that means the longer-term rates are likely going to have to continue to move higher, or the longer-term bonds have to continue to drop in price. And if we are going to issue more bonds, we're going to reissue debt, then bond prices will fall. So the bounce in bond prices I expect to fade. But after bond prices fade, then you'll start seeing the opposite of what we talked about just a minute ago, which would mean that we'd be looking for bond prices and equity yields just to start going in the opposite directions. Instead of seeing them rise together, we're going to start watching for them to fall together. And so let's just use this, where bonds will rise on some days while equities fall and vice versa. And this disinflation or deflation, which they don't like using the word, but disinflation will occur at some point. But right now we're not seeing it. If we're looking at the rates, we're not seeing any indication that we're cutting rates. We're not seeing any indication that we're raising rates, but we're seeing the data supporting the idea that inflation is still high. We need to raise rates, either let the economy do it, the market do it by dropping bond prices and pushing yields higher, or the Fed has to step in and raise rates. Now, maybe they're betting on the fact that they won't have to step in, so they can say, oh, it's the economy that is charging you more, not us. But in reality, in the end, it is the same thing. So if we look at this a little closer and say, well, what does the Fed watch tool say? What are they expecting? We can take the Fed watch tool from the CME, and you can see that December we're still pricing in about a 20% possibility of a rate hike and a 3% possibility of a rate cut. Well, I'm going to be leaning to this 20% possibility, or just saying, hey, 77% says we're going to leave it alone. We don't really see this turn and start favoring cuts until after March. So March, we still have a 20% probability of rate hike and maybe a 16% by March for a rate cut. You look out to May, and then that's when we start shifting it to show that we're looking at rate cuts by possibly May, but not until after March. So March, April, May is when we think that we'll see the justification to do rate cuts, but we're not pricing that in now. Everything is pricing in rate hikes, or nothing. And based off the data that we got from the Federal Reserve press release, we are seeing that they are not planning on doing anything now, but they are certainly justified to continue to raise rates, and they are not justified any cuts. So why the market's pricing in peak interest rates, that's betting on it not moving. It is really not betting on it going lower. And I would say it all comes back to this. The money supply is tightened down so much, and they did not get the response, the reaction, the outcome they wanted, and they're afraid to raise rates again, because when there's no money supply in the market and the rates are continuing to go higher, consumers will stop borrowing or be maxed out on their credit cards. Government will have to issue new debt and renew old debt at some of the highest levels, if not the highest levels, in over 2 decades. And that will continue to press the market as far as spending, and you will see inevitably a major slowdown in economic performance. And just to see an intraday reaction, higher highs, higher lows, higher highs, higher lows in the ES, pushing up to this previous high, taking us all the way back to last Wednesday's open. So we've now erased the entire week of selling and returned to last week's open from last Wednesday. So we've erased that. We're pushing higher. This is all betting on the Fed not raising rates, and we're leaning on that. If you look at the NQ, same kind of thing. We're up a little bit higher than Wednesday's open. No, actually we're not. We were a second ago, just testing that Wednesday open. So same kind of situation. We've just erased a week. That's all it is. Our week is flat if we look back 1 week ago to Wednesday. And this is happening while the US dollar index is holding near these highs. Now this is a very wide range. We went to 107, down to 106, back to 107, back to 106. It's creating a double, triple top type of situation. But it's still near the weekly highs. The dollar has been able to hold up near its weekly highs. In fact, if you look back even further, the dollar has held up to its multi-month and almost 9 months, 10 months highs for the dollar versus other currencies. So the dollar is still retaining its purchasing power on a global stage, even if it is not retaining its purchasing power against U.S. equities. So we're seeing a lot of strength in the U.S. dollar. What does that tell us? It says the U.S. is experiencing inflation, but we're more concerned about other countries and their currencies than we are the U.S. It does not mean that we do not have inflation. The dollar is gaining against other currencies, but not against equities. And so the dollar is winning. Watch for this. If the dollar decides to break out and move higher and clear this high, a stronger dollar will likely see a peak in equities, and I would probably favor the Russell down more than the Nasdaq or ES, because again, the higher borrowing rates are going to require more stretching for the small caps to continue to run. And so I would be looking for this to fade off of anywhere below 1700, and then we will likely see a break below the low and a continuation with lower highs, lower lows in the Russell. Today's little tiny rally is not that significant considering how far the Nasdaq has run, almost 2% up. The Russell's only made it up 0.4%, and I would be leaning to favor shorting the small caps or any companies that are leveraged in debt. Well, that's going to do it for me today. Have a fantastic day, and we'll look forward to talking to you again next week.